Hello, this is Lara at Elliott Wave Stock Market with your end of the week analysis for the trading week ending Friday the 26th of January. The upward trend continues, the trend is strong, corrections are an opportunity to join the trend. In the short term, I'm not looking at this stage for a reasonable interruption to the trend. Corrections should be shallow and brief for a little while yet. The structure is incomplete. I've calculated a new target for the next small interruption at 2896. The target after that is still the same at 2951. They're both for short-term interruptions to the trend. Both should be over within a week. It looks like a third wave is still incomplete, and even though this trend continues and it is still showing strength, risk management is still absolutely essential. At the weekly chart level, the wave count's unchanged. It still sees cycle wave 4 ending here and cycle wave 5 beginning here as a 5-wave impulse, which is incomplete. So far we have 1, 2, 1, 2. We need to see the end of 3, 4, 3, 4, 3, 4, 5. So the upcoming corrections for intermediate 4 and primary wave 4 should be multi-week corrections. They should probably also show up at the monthly chart level, so be longer than a month, so that the wave count for cycle wave 5 has an obvious 5-wave impulse look at the weekly and monthly time frames. A third wave begins here, and so far I expect we have 1, 2, and minor wave 3 is incomplete. Minor wave 3 may only subdivide as an impulse. I expect so far we have an extended first wave, a second wave, brief and shallow, a third wave incomplete, and we have a little fourth wave and a fifth wave up to complete minor 3. And so please note that this wave count still expects that a third wave up is coming toward an end and still not complete. That price is still within a third wave at 1, 2, 3, 4 degrees. And so we should be seeing increasing, a reasonable amount of strength, extreme indicators and overbought conditions, and that can persist for quite a reasonable period of time when this market has a strong bullish trend. And I've gone over the last cycle degree fifth wave, which is up to, I think, the 2000 high. And I've looked at the third wave within that, and I've published a link to that in the analysis where I looked at that chart for you, and I looked at the classic analysis for that piece of movement, and I showed you how extreme indicators can get when the S&P is in a third wave at primary degree within a fifth wave at cycle degree. So that's the closest equivalent in terms of Elliott wave we can see. So we can look back to that historic example and see how the indicators that I used behaved, and so we can expect we don't have to see the same situation, but we could certainly see something quite similar. Markets don't repeat, but they can rhyme. Third waves can only subdivide as impulses. This channel, which I'm drawing now at the weekly chart level because the previous channel's been breached to the upside, this is an acceleration channel. We draw it from the end of a first wave to the last high. We normally place for an acceleration channel the lower edge around the end of the second wave, but in this case I'm going to pull it down lower so that it contains all of this movement. So we're drawing a channel around intermediate wave 3. When minor wave 3 is complete and minor wave 4 finally arrives, if it's very deep, and I don't expect it will be, it could end midway within the channel, but it could end about the lower edge of that channel. When intermediate wave 3 is complete and intermediate wave 4 arrives, it should breach this channel, drawn around intermediate wave 3. But for now, we're looking out for the end of minor wave 3 only. Minor wave 4, when it arrives, may not move into wave 1 price territory below 2400.98. A word again about these targets. This next target at 2926 now looks to be quite a lot too low, and the targets on the daily and hourly charts now do not work with this first target. And so the second target, I know it's really high, but at this stage, with this structure and the Fibonacci ratios I'm using, the second target for cycle 5 is now looking quite a lot more likely. At that point, cycle 5 would reach 2.618, the length of cycle wave 1. Let's take a look now at the daily chart level, where the highs for minute waves 1 and the low for minute wave 2 Minute wave 1 just off to the left of the chart. Here's the low for minute wave 2. It was a very shallow correction. It lasted only 9 days, so over within 2 weeks. And the impulsive structure for minute wave 3 still looks to be incomplete. We still see an increase in upward momentum. That's absolutely normal, and that's exactly what a third wave should look like. Minute wave 3 may only subdivide as an impulse. I expect so far we have a long extended first wave, a brief and shallow second wave correction, subdividing as a combination. Minuet wave 3, may reach equality in length with minuet wave 1 at 2951. If it reaches only equality in length with its first wave, then both the first and third waves would be long extensions. If that happens after minuet 4 is completed, we'll expect minuet wave 5 may not be a long extension, because within an impulse, only 2 of the 3 actionary waves may be extensions, not all 3. The upward slope of this portion of movement is stronger now than this portion of movement. That's absolutely what a third wave should look like. So this wave count for the last quite a while now, a few weeks, has been following it's pretty much exactly what we expect price to do, despite a lot of perma-bearishness out there. That's why I've gone and linked you back to show how extreme the S&P's bullish trends can be. When minuet wave 3 is complete, then minuet 4 may not move into wave 1 price territory below 2694.97, but it probably won't get very near that point at all. It'll probably be relatively brief and shallow. Okay, let's take a look at the classic analysis, and let's look at why I'm still so very bullish for this market. It just keeps on going up, doesn't it? We've got another strong bullish week, and overall at the weekly chart level now we do have some increase in volume to support the rising price. It's not absolutely consistent week on week, it doesn't have to be, but we have an overall rise in volume. On balance volume is very bullish. RSI is very extreme, but it can remain extreme for quite a long period of time. There's still a little bit of room for it to become more extreme. And then we'll expect it to develop some clear and strong divergence with price before we expect we're going to have a big interruption to the trend. At this stage, there is absolutely no divergence with price and RSI to indicate any weakness. ADX is very extreme. It's above 35 and it's above both directional lines. It can continue to remain very extreme for quite a reasonable period of time when the S&P has a strong bull run, and so this is absolutely hopeless as a timing tool. It will not tell us when the bull run may end. MACD is still full bull bullish. What about the short-term picture? At the daily chart level, price is still closed within Bollinger Bands. That's okay. We've got a strong bullish candlestick for Friday's upward session. The short-term volume profile is a bit bearish, but that can continue for a while, yet price seems to be just drifting up due to a lack of resistance overhead rather than any serious support from buyers. It does seem to be a mid to long-term feature of this bull market, and the only comment I'll make about that as well is that it means that eventually when the bull market turns into a bear market, because there's thin trading volume here, there won't be a lot of support when a bear market starts to fall, so it could be very, very, very quick. ADX is now very extreme at both daily and weekly time frames, but again that's absolutely hopeless as a timing tool, and it can persist for quite a reasonable period of time when this market has quite a strong bull trend. Rising ATR now supports the rise in price. On balance volume remains very bullish, absolutely zero divergence and no bearish signals whatsoever from on balance volume. RSI, there was some divergence with price. It was quite weak. Now that's completely disappeared. Still room for it to become more extreme. Can remain extreme for quite reasonable periods of time when this market has a strong bullish trend. Again, this is hopeless as a timing tool. Stochastics can remain overbought for quite a long period of time, and there is tiny little bit of divergence, but I am not going to note it because it's not clear and strong enough to indicate enough weakness in order to call a halt in this upward trend at this time. MACD fully bullish, Bollinger Bands widening supports the upward trend. This trend is extreme and it is overstretched, but that can continue for quite a long period of time when this market has a strong bullish trend. What about VIX and the AD line? There's still this mid to short-term divergence between price and inverted VIX. Price is making new all-time highs, but inverted VIX is failing to make corresponding new highs. That's actually okay. This isn't really a very good tool for indicating a turn. The last several bearish divergence signals given from inverted VIX have all completely failed to be followed through by any reasonable downward movement. At this stage, it's either simply not working as it used to, or it could be an early warning sign. It doesn't appear at this stage to be a very useful timing tool, which it has been in the past, but at this stage that relationship appears to have broken down. This one's a little bit better though, a little bit more reliable. Here we had a bearish signal followed by a downward day. Here we had a bearish signal, followed by a bit of sideways movements. That didn't really work. We had another bearish signal here that failed, and now we've got another bearish signal here. Now that certainly could fail. The new all-time high in price for Friday has not been matched by a corresponding new all-time high for market breadth. The rise in price for Friday has some weakness. It was not supported by rising market breadth. Now that may indicate that the alternate hourly wave count is correct, and we might get a little wee correction here to resolve that, or it could simply disappear like it did the last time that we saw it happen here. And so, unfortunately, that's actually not that good as a timing tool either. And that's why, another reason why the main wave count is the main wave. Hi, this is Lara at Elliott Wave Gold with your end of the week analysis for the US oil market for the trading week ending Friday the 26th of January. The bottom line is we should assume that the trend remains the same until proven otherwise. While price remains in that small, narrow, yellow channel on my daily chart, assume that upward movement will continue. There's not enough weakness at this stage to indicate that it should be over. And because of that, I have a new alternate wave count that's very, very bullish for you. But that alternate requires a new high above 74.96. If that happens, that would be a very strong indication that oil is in the early stages of a long-term bull market, and the target for the short to mid-term would be 80.64, but I'd be looking for a big correction before it got there. If price breaks below the lower edge of the yellow channel on my daily chart, then look out for a continuation of downward movement for a new low below 26.86. Elliott wave analysis first, classic analysis last. I'll be looking at monthly charts and the volatility index. My wave counts see a first wave over here and a second wave either continuing further as a zigzag, or the alternate will look at it as over. This wave count has a better fit. It has a subdivisions for a zigzag 5, 3, 5. Primary wave C is an extension. It's expected to be subdividing as an impulse for this wave count. 1, 2, 3 is a nice impulse, 4 is a zigzag, and then we'd be expecting a fifth wave down when 4 is complete. 4 may not move into wave 1 price territory above 74.96. This week though, prices closed above the upper edge of this resistance line. That's another reason why I have a new very bullish alternate for you. However, this wave count is still entirely valid, and this trend line has not been perfectly showing where price found resistance before. It was broken through here, back test for support a couple of times, moved up and away, and then moved quickly below that line. It's possible that primary 4 may be just overshooting the line, and then we may come back into the line. Let's have a look at this at the weekly chart level, the structure of the zigzag for primary 4, beginning here beginning here at the end of primary 3. Primary 4 may be a zigzag subdividing 5, 3. I know it's a 5-wave structure, but we classify a triangle as a 3. It's a corrective structure, and this 5-wave structure up, if it's begun down here, may now be complete for intermediate wave C. This wave count sees intermediate wave B beginning here as a running contracting triangle. At its end, it affects a net retracement of intermediate wave A, and that it moves back into intermediate wave A price territory. This wave count has a big Elliott channel drawn around the zigzag, and if we see a new low or a full breach on the daily chart with a full daily candlestick below the lower edge of this channel, we can have quite a lot of confidence that we have a high in place and we're probably going to see new lows for oil. But right at this point, and maybe for the next couple of weeks or so, oil is at an inflection point. Both wave counts are going to remain valid, and the second or alternate wave count, this also has a reasonable probability. Having a quick look at the structure of intermediate wave C on the daily chart, it subdivides as an impulse, 1212, 3434, and an extended fifth wave. The subdivisions here could again also be all complete, 1, 2, 3, 4, 5, and the Fibonacci ratios are put on this chart here. I need to fix that arrow and put it up here. Primary wave 5 would be likely to move at least slightly beyond the end of primary 3 at 2686 to avoid a truncation. But this is my bottom line now for this wave count. We need to see a breach of this channel by a full daily candlestick below and not touching this trend line before we can have any confidence at all that we do have an end to primary wave 4. This wave count now at this stage comes with that very strong caveat. Let's take a look at a new alternate. At the monthly chart level, I'm still seeing a supercycle wave 1 over here and a supercycle wave 2 beginning. And now, what if supercycle wave 2 is over as a zigzag subdividing 5, 3, 5. If the B wave is over here, then primary C has moved beyond the end of primary wave A. The B wave is a zigzag and wave C has avoided a truncation, although the B wave for cycle wave B, when it's seen over here rather than here, does have a price extreme within primary wave B that's above the end of primary C. The rule about, well, it's not a rule, but the Elliott wave situation with truncations is it refers to fifth and C waves in relation to the third and A wave. It doesn't mean that it has to move beyond the price extreme of the B wave. And when you have running triangles or expanded flats for a B wave, they can have a price extreme that's beyond where the C wave ends up, and it's not actually technically correctly a truncation. Primary wave B here is labelled as a rare 9-wave triangle. This will fit quite nicely, and at its end, for intermediate wave I, it has affected a net retracement of primary A. Primary B's end is within primary wave A price territory. This is an entirely valid wave count. It's just a little bit unusual, so it would have a slightly lower probability, but it is valid. Primary wave C here now has slightly better looking subdivisions actually. It fits nicely as an impulse, 1, 2, 3, 4, 5. Now if it's correct that we have a 5, 3, 5 zigzag over at the last low for oil at 26.06, then what that means is oil should be still in the very, very early stages of a huge new bull market. Supercycle wave 3 must move beyond the end of supercycle wave 1 above 146.73, and it has to move far enough above that point in order for there to be enough room for a big fourth wave at supercycle degree to unfold and remain above first wave price territory. The target for supercycle wave 3 to end would best be calculated at cycle degree. So I've just got this minimum requirement rather than an actual target at this stage. When cycle waves 1, 2, 3 and 4 are all complete, then I could calculate a target at cycle degree for supercycle 3 to end. I can't do that yet. This is only a tentative wave count at this stage. If we see a new high above 74.96, you may have some reasonable confidence, I expect, in this wave count, because the main wave count would be invalid. Let's take a look at this at the weekly chart level, where supercycle 2 low, maybe this point down here. In order to see an impulse beginning upward, we have to see this is a 5, a quick zigzag for primary 2, an impulse for intermediate wave 1 is a little bit problematic. There's disproportion between 4 and 2. It will fit, but that disproportion gives this movement a little bit of an odd look. A double zigzag for intermediate wave 2, that has a really good fit. It's a lot longer lasting though than intermediate wave 2. Oil doesn't always have really good proportions though, so this should be considered entirely as a valid alternate. A third wave at 2 degrees may have begun here. The target for intermediate wave 3 assumes the most common Fibonacci ratio to intermediate wave 1. About that point would be expecting a trend change and a big correction for intermediate wave 4, which may not move into wave 1 price territory below 55.24. To the downside, this is the price point that clearly differentiates between this alternate and the main wave count. A new low below this point would invalidate this alternate and add a lot of confidence to the main wave count. To the upside, this is the price point which clearly differentiates the two wave counts. A new high above this price point would tell us oil would be very likely to be in the early stages of a huge new bull market, and that would invalidate the main wave count, which sees oil still in a bear market. That's one of the nice things about Elliott wave. We have alternates, and that's the correct way to do Elliott wave. And when you have an alternate wave count, you figure out at which point an Elliott wave rule would be violated, and that's your price point, which I call an invalidation point, which can differentiate your different ideas. At the monthly chart level, let's make that a bit bigger. I noticed in last week's analysis that here on the monthly chart we had a nice continuation pattern, 3 advancing white soldiers. It's been followed by another monthly candlestick with a longer lower wick, that's bullish, and now it's been followed by a very strong monthly candlestick, again bullish. And the only problem about candlestick continuation patterns is it tells us the trend is likely to continue, but it makes absolutely no comment on at what point that trend may end. It's hopeless for calculating targets. It's just good for indicating the most likely direction. Up to last month, we had rising price on overall declining volume, and so the rise in price here was not supported by volume, but this month we're starting to see an increase in volume. The month's not quite over, this is the month of January, and so for the short term, this strong monthly candlestick now has some support from volume. Overall, we may still be seeing a decline in volume, but we do need to let January end so that that data is complete before we can make that conclusion. RSI is still in neutral territory, so there's plenty of room for price to rise or fall. MACD is still bullish, not full bore bullish, but quite bullish, and on balance volume is bullish. I will note that there is some divergence between this swing high and this swing high, and this high and this high from on balance volume. It's quite weak though, and so I'm not going to note that on the monthly chart as a bearish signal. I'm just going to say that on balance volume does look overly bullish. It just doesn't work as well with divergence as it does with these trend lines. What about the short-term picture for oil? There is now some reasonable divergence between price and stochastics is overbought. It's not as clear and strong as I'd like it to be, though before I expected that we probably had a high in place. It does look like this trend is now quite extreme, and stochastics overbought and exhibiting divergence. It looks quite reasonable to expect maybe a consolidation or possibly a trend change about here. That would offer just a little bit of support to the main wave count. For Friday's session, we had a lower high and a lower low, but it closed green, and the balance of volume for the session was upward. Volume shows some decline, and so during Friday's session, the upward movement within that session does not have support from volume. The short-term volume profile is therefore interpreted as bearish. Moving averages, though, are full bore bullish. The short is above the mid, and I use Fibonacci numbers for these. I've got 13 and 55, and here's the long-term 200-day moving average. They've all got positive slopes. The short is above the mid, is above the long, and price is above all three. That's a full bore bullish look. They are lagging indicators, though. ADX is very extreme. It's both above 35 and above both directional lines, telling us the upward trend is very extreme, but when oil has a good bull trend, it can remain extreme for quite long periods of time. That's really typical of commodities. They can have extreme bullish trends. ATR is strongly increasing now to offer quite a bit of support to that upward trend, and on balance volume is very bullish. There isn't enough clear divergence between price and RSI to indicate enough weakness to tell us that we may have an end to the trend, and so stochastics may only be indicating a consolidation within the upward trend to come rather than the end of the upward trend. Bollinger Bands contracting toward the end of this upward movement may indicate waning strength in this trend. And what about the Volatility Index? For these 3 days, we had upward movement to a new high here, but it did not come with a normal decline in volatility. Volatility has increased, so that divergence is interpreted as bearish. That would favour the idea, again, of a consolidation, at least, if not a trend change at this point. And that's all from me with your extra video update this week, and I hope that all of our members and viewers are having a fabulous weekend.